I am a loan officer with Mercantile Bank. I've been in the mortgage industry for the past 2 years. I've been in the financial industry. Um, I started over 20 years ago. I've served as a home buyer educator, credit counselor. And one thing Tanya mentioned earlier is it's not easy, but I believe it is very necessary to change the trajectory of our community. I'm glad we're having these conversations more frequently. And as far as credit goes, I believe we should have this conversation much earlier because there is knowledge and then there is behavior. So we are learning it. You must apply these behaviors over time to change what we have seen in our community as far as access and wealth building goals. And that's why I have a passion about educating people about how to gain mortgages because home ownership is the cornerstone of building wealth in this country. So let's get started. Where do you go to get a mortgage? You can go to your bank. You can go to your credit union. You can go online and get a mortgage. There are mortgage brokers that are kind of like, a wholesale shop. They may offer a different variety of products. I am at Mercantile Bank. You can come sit with me in person. There's ways to complete an application electronically. The point is you have many ways to access a mortgage. Ideally, you would have spent time preparing, building credit. You can start from today and be at zero credit score and build history in within 2 years, which is when I get to the income, which is the amount of time for the income we're going to verify. The point is, if you had never thought about this, you can take this education and become a homeowner in 2 years if you apply the knowledge. So you have options of where to get that mortgage. There are different kinds of mortgage products. There's a conventional mortgage, which is privately backed and bonded mortgage. There's FHA, which stands for Federal Housing Administration. Those are government backed and bonded mortgages. There's rural development, that is RD, that is determined by the census tract, as set by USDA. You may hear these acronyms. I feel it's important to let people know because the terminology can confuse people to the point where they're like, I don't even want to go any further. So USDA stands for U.S. Department of Agriculture, and they give rural development loans. VA stands for Veterans Administration, and those are mortgages that people that have served in our military can take advantage of. So all these are various mortgage products. So first-time home buyers can take advantage of any one of those and pair additional down payment programs or additional products with those loans. So you could get a conventional mortgage and use a down payment program together with that, same as FHA. If those the investor is what they're called allows that with their program, you can use it. Once I have assessed the client, then I can determine what you qualify for. So as Tiffany said, everyone is different. Until you are assessed individually, we won't know what you may be able to do. Okay? Everyone's different. Everyone's work history, everyone's credit profile, everyone's income is different, but it's a good loan officer's job to assess you and give you all your options and support you on that journey. Rates and terms. Rates, there's a lot of conversation on the news. You may have friends and family. We know we're in what's called a more volatile market right now. Do I think that you should not try to prepare or even purchase in this market? No. Home buying does not cease in volatile markets. It slows down, but it's always a good idea to buy a home and have a mortgage. Question for everybody, show of hands. Who's paying a mortgage? Somebody, I see some hands that aren't down. You're paying your mortgage or you're paying someone else's mortgage. So that's perspective for you. And if that could be perspective, why not, even in a volatile market, prepare to pay your own mortgage? Because if you're paying rent, your landlord is benefiting that so they can pay their mortgage. Yes, it's a risk, but it's also a reward and a responsibility. As I said, to build wealth and to have equity. When we pay our rent, we don't see those funds. Again, when you pay on a mortgage, you build equity, and that home can become your very own bank to finance your future goals, to finance your children's college education. We'll talk about the impact of student loans. Maybe, that could come from the equity that you build over time in your home. You start now, your children are young, you're planning for their future and to set them up for success and build generational wealth, which again is one of the pillars here. And I know that is important to Tanya, Tiffany, and you in this room as well. So rate, or we talked about rate, again, is going to be individual to you. So I'm not going to dive into a rate conversation today. The term is just meaning the length of the mortgage. And there's a variety of terms that you could have. The typical term is 30 years. That's 360 months. You can also have a 20-year mortgage. You can also have a 15-year mortgage. You can refinance whatever mortgage you start with to something that's more advantageous. Sometimes we do what we got to do to get in the door, and then we set up a plan to adjust that in the future. Anything else I want to touch on? Anything that you do close as far as the rate and term is disclosed to you on paper and identified as fixed, meaning it cannot change unless you take an action to change it, or adjustable, meaning it could change, and those terms will be disclosed to you. So if you hear ARM, that stands for adjustable rate mortgage. An example could be for the first 5 years, you have a fixed rate, and for a period of time, say every 6 months following that, the rate could adjust based on the market. In this kind of volatile market, that could be scary for some folks because it's based on the market. And one thing I will, before I move on from this conversation, is let you know that the rate is set by the Federal Reserve. Various financial institutions have margins where they can make adjustments, but we don't initially set the rate. So this economic condition that we're in, everyone is feeling the impact, and it's affecting mortgage rates, auto loans, credit cards. Check your credit card statement when you get home and see if maybe last year you thought you were paying a certain rate. Just take a look and see if you haven't already done so, what you're paying now, the cost to borrow money that we all pay. And just know that you have many options and you should learn them all and pick one that works best for you. So as it comes to home ownership, think about a few things. Your budget. What is going to work for your monthly budget? Home ownership is a big responsibility. In addition to the mortgage payment that you must make to the bank if you want to keep the home, there are maintenance fees, unexpected fees that as a renter, maybe you didn't know were responsibilities, but now as a homeowner, you are responsible for that roof. You are responsible for that furnace. In our Michigan winter, we can't have, no emergency fund. If the furnace goes out tomorrow, you must take action to get that corrected so your family can be safe and warm throughout the winter. So those are the different kind of things that you want to think about as you prepare for your journey. And if you do start the pre-qualification process, which I'll get into next, what you will be able to show. I'm going to answer your question that you asked. You asked if can you get a mortgage zero at the closing table? So are you asking, can you not contribute any funds to a mortgage transaction? Okay, the answer is no. You will have to make an investment of some sort, and I will have to verify that before we even get into the transaction. Earnest money, which Tanya will probably touch on, is your initial investment that you make and give to your realtor as a show of good faith. So that's cash out of your pocket up front. It is deducted from your closing costs, but I have not seen a scenario where a borrower will have $0. Um, there could be various programs that may advertise that, but you have to be aware that there's loan fees, there's escrow accounts, taxes, and insurance that must be paid to third parties, the city, your insurance company. So I'm not aware that there will ever be a transaction where the borrower would contribute $0. So in speaking of the financial aspect, we are verifying the earnest money, and this is where the paper trail comes into play. We're gonna assess what's necessary and where these down payment funds are coming from, and then the closing costs and prepaid items. So I spoke on the loan fees, the escrow account that pays the homeowner's insurance and taxes on your behalf, and then interest, prepaid interest before you make your first mortgage payment. So the day your loan closes, there is a balance of money that you're responsible for, and all of that is itemized for you. The paper trail, I can't express it enough how now, as you're paying off credit, because you may do things to correct your credit in 3 months or whenever I get to your file, and I may have to have proof of that to make it count. If we can't show proof, then it doesn't count. Have you ever heard the saying, if it's not written down, it didn't happen? Think of that as it relates to the mortgage habit. If we can't prove it, I may not be able to use those funds. Okay. All right. Something else you want to think about is how much you want to spend for a down payment, which may affect which kind of mortgage program we use. The mortgage payment is going to include principal, interest, taxes, insurance, and more private mortgage insurance. You will have, we can do quotes similar to auto insurance for the mortgage insurance, but if you get an FHA loan, there's a premium that's set by the Federal Housing Administration that is a percentage of the loan amount. So you don't have an option there. If you get a conventional mortgage, we can look and see, are we going to pay the entire first year mortgage insurance up front to lower your payment, or are we using a down payment assistance program that also lowers that percentage that you pay for mortgage insurance? Just like your auto, the lender wants to be protected if something should happen. So you do have to pay that as a portion of your monthly payment. And then home maintenance, as I touched on again, that could mentally, that should be in, you may not see that on paper, but you want to save a portion for those unexpected things, or just for the cosmetic upgrades you want to do to your home to increase the value. Another thing to think about, are you purchasing your starter home or your mansion on the hill? This will speak to the amount of time that it takes to prepare for this. Do you want to just get into the home ownership game to stop paying rent, start building equity, and then in 5 years you'll plan for that dream home purchase? You have to kind of be honest with yourself about what it is you want, and then share that with your loan officer so we can work together to make a plan. As Tiffany said, it's a partnership, and because you're unique and there are many different options, it's best to be transparent about what you want, and the loan officer should be transparent about what's realistic, and if that's a not right now and we're going to plan for it later, or you are in a position to have exactly what you want at the moment. All right, so the keys to loan approval. There are 4 legs of a table needed to get a loan approval. They are credit, as Tiffany touched on, income. You must be earning some type of income when you apply for a mortgage. The different kind of income could be your job. You could be a W-2 employee. You could be a business owner, be a self-employed borrower. You could get a mortgage with Social Security. Child support counts. You could receive a pension. The point is, you have to have some income at the time that you apply for the mortgage. Assets, funds for down closing, or for the down payment and closing costs. We verify that up front with your 2 most recent bank statements. In a mortgage transaction, that you're borrowing funds in. Cash is not king. So put the money in the bank if you are saving it elsewhere, because I'm going to collect the two statements prior, and then all the documentation has to be in current in the file. So a mortgage transaction can have many unexpected things happen, because again, we're working with appraisal companies, title companies. There's the seller, there's the borrower. So because it's unexpected, if we have to collect documents, you want to show some consistency on paper. If you couldn't speak for yourself, you want your documentation to speak for you. You want consistency in your pay stubs. If you're working 40 hours a week and you tell me that, I need to see that on every pay stub. If I see 36 hours, I'm going to have to make an adjustment. You want to just think, if I am not saying anything, my documentation is consistent throughout. If you show me I have this amount of money in the bank, I want to see that or more. I don't want to see less, because then we're going to have to make adjustments. So again, paper trail. So for the borrower, credit, income, assets are the keys. And then once we have the house, you're under contract, then that collateral is assessed as well. And that has to be improved by the investor. If it's conventional, if it's FHA, these are different guidelines. And you will work with your realtor to make sure that those guidelines are met for a successful transaction. If not, in the underwriting process, we will find out the requirements. Can they be met? Or no, this transaction won't work, or this home is not eligible, and then we may have to make some adjustments. So I guess my takeaway that I would say is be willing to be flexible, because homeownership is such a lofty goal. You could, have your heart set on something and only want to see one outcome, but you have to know that we may have to pivot, and you want to be flexible throughout that process until closing. All right, so documents needed. Your loan officer is going to ask for your W-2 employees, your W-2s for the past 2 years. So it's December 2022. Right now, if you were to apply, I would need to see all W-2s from 2020 and 2021. In a couple of months, I'm going to start asking for W-2s from 2021 and 2022. So we're going to assess the income for the past 2 years. Test 1, 2. All right. Okay. So, 2 most recent W-2s, 2 most recent pay stubs. And again, these will be recent to the file. So if you're out house hunting for a month, then I'm going to need more pay stubs. We got to keep everything in the file recent. 2 most recent bank statements. I suggest sharing all financial statements, and I see sometimes hesitancy to disclose to the loan officer all your assets. And I want to say it's better to overshare in this scenario, because the loan officer's job is to assess what we actually have, to give options. It doesn't mean if you show me all that you have, I'm going to make you spend all your money. But I would rather know what our options are and educate you on those than not have enough data, or have to struggle collecting documentation later in the process, and have to explain things to the underwriter. So share all the statements you have. You can use your funds in your savings or checking account. You can have a gift from a close family member. This is a parent or a child, your play cousin or your second aunt twice removed may not count as someone if the relationship doesn't make sense as far as gift funds go. and we're going to verify their funds as well in their bank statement, and they have to have a letter stating that it is truly a gift. It is not expected to be repaid. Borrowing money for a mortgage is not a good idea. It's actually not, I'm not going to say not acceptable, but it shows Tiffany used thirsty for credit. So if you are looking to borrow funds to buy a home, which is borrowing money for a 30-year mortgage, there's a mindset shift that needs to occur, because you have to make an investment into the transaction. You're asking a lender for funds to pay over 30 years. You could pay them back quicker, but you have to say, I'm good for this by putting your money into the transaction and then showing on paper the history, the credit history that we look at, the pay stubs and the bank statements. Angelique, did you have a question? No, there's no limit on how much can be gifted. Specific to the program and the client, there could be, but generally speaking, I would rather you present the documentation to me so we can get to those details if something is different for the client. Okay. So the documentation we were discussing, all other income statements, again, Social Security, disability, child support, pension, all those things can be used in a mortgage transaction. So if you are using that, I just need the current statement saying what those benefits may be. And also your valid driver's license or state ID, which has to be current, no expired IDs. Everyone needs an ID to apply for a mortgage. Yes, Jay? As far as gift funds or in general? Mm-hmm. Mm-hmm. No, I want to see the paper. That's the verification. So straight from the bank, I want to see the most recent bank statements. I can't take screenshots of these bank statements. I don't want a transaction history. I want the bank statements from the bank account to verify your funds. Any can't come from underneath the mattress. It can, but after it's seasoned and is set in the bank for 2 months, then it's verified funds. I have had scenarios where one memorable one, a young couple getting married, and they had a celebration over the weekend, and of course their family gifted the money for the upcoming nuptials, and then you see this cash deposit, and what is this? You know, these are gifts from our friends. Well, we can't verify those funds. There's no paper trail. Unfortunately, it can't count. Now, you need a home inspection. Use the cash for your home inspection or something like that in the transaction that will benefit you. But if you throw some mattress money in the bank, I can't count that tomorrow. And I have that conversation often, and I can't reiterate enough. Paper trail, and put the money in the bank. The longer, the better, because it shows stability. This paper is speaking for you. It shows security. Any other questions around how we verify the funds and what counts and what doesn't count? Okay. So you want to organize your finances and your documents. You want to complete an application, an individual or joint application. If there are more than one borrower, everybody needs to be on the same application. If we're going to change, that's going to be a new application. For some instances, in some instances, someone will apply and then they'll say, okay, I want to add such and such. Okay, we have to do a new application. Or some people will apply jointly, and then we may have to remove a borrower for whatever reason. That's another application as well. I'm going to do a plug here. We are doing a pre-qualification day in January. I find that it's better to pre-qualify or to apply and learn where you stand instead of I have a lot of hypothetical scenarios, and I truly need to see your income, your credit for sure, your assets to best advise. So a hard inquiry does impact your credit, as Tiffany stated, but for the purposes of obtaining a mortgage, you want to learn where you stand so you can specifically attack the things that need to be fixed. because it is different from applying for a credit card or different from applying for an auto loan. A home is typically the largest purchase you will make, so those requirements are stricter, but it will be the most beneficial purchase you will make. So my suggestion as you do this credit work is prepare for a mortgage and then have fun with the credit. Because once you do have a credit on a mortgage on your credit, your score is going to impact in a different way. One thing you talked about is the types of accounts. So a mortgage is its own type of account on your credit. Then there's installment accounts and revolving accounts. So once you do successfully get the mortgage, your credit score is going to boost as a benefit of having that specific type of account. So my advice is build for your credit or for your mortgage purposes, and then you'll enjoy more benefits of all that hard work that you've built that credit for over time. Once you have completed the application and had your documentation assessed, then you will learn, or if you're pre-qualified or pre-approved, those words are used interchangeably in the mortgage world. Typically, pre-qualification can be just you telling the loan officer those things, and the pre-approval is a verification of those things. But you want both. You want to give over the pay stubs, because if you're not salary and you're an hourly employee, we know that income fluctuates. So you may be calculating based off a 40-hour work week, but we may use 38 hours. And that makes a difference. So I suggest giving the documentation over and allowing the loan officer to scrutinize that documentation to give you the best information. People will just want to know details without providing any documentation, and that's understandable. But for the best information, you want to be very transparent and work with the loan officer to get the most accurate information. Once you are pre-approved, you will learn the details of your mortgage program. If you are doing an FHA mortgage, which at Mercantile Bank, the lowest credit score that we will do a mortgage at is 580. That is definitely going to be an FHA mortgage. I'm going to tell you about FHA specific programs. If you say I want a conventional mortgage, I'm going to say, okay, this is what we need to do to get you closer to the average number is 680. That's 100-point difference. If you want that specific type of mortgage program. So I will say, this is what we can do. These are your options. Do you want to proceed, or do you want to make a plan and proceed later in the future? Nothing is final until you sign at the closing table. So that is kind of where it goes back to being flexible throughout the process. I think people think applying is committing, applying is learning, applying is planning, applying is preparing. But when you get to the closing table, which is the most exciting day, and you sign, that's when things become final. There's so many things that happen in between there, and a lot of education for the clients that can happen. So you might not get it all up front, but you will learn as you go through the process. And then once you have gotten your pre-approval letter, then you will go out and shop with your realtor to find the home that fits. Once a contract has been received on a home, then we come back to the processing and underwriting process. So in a mortgage process, there could be many underwriting processes. I do an automated underwriting up front to determine if we are pre-qualified to move forward. If we get an approval there, then you go shop. And for the people that get that initial approval, you shop, come back. It's underwritten again by my processors, a fact checking to make sure we can actually do this loan. And then once we assess you, your documentation, we call the job, the employer, hey, does such and such work here? This is their start date, end date. Yep, okay, that's verified. The house, we're doing appraisal. The value meets the sale price. Okay, great. Then the underwriter again verifies and does a process for that. So throughout the process, you will go through multiple underwriting, and we have to just keep passing each one to get to the closing table. If there's a hiccup in the mix, we either have the opportunity to correct, or sometimes we may have to go back to the drawing board. Again, each situation is unique, so we don't know unless we go down that path. Hopefully we make it through all the underwriting processes and we get to the closing table, where you will sign and the ownership will change from the current, from the seller to the buyer's hands. Your responsibility after that is the housing payment, again, which I discussed. It includes the principal, which is the repayment of the balance of the loan only, the principal amount of money. There is another amount, there's another category of interest. Because this is such a long loan, initially you pay more interest up front. And you get what's called an amortization schedule at the closing table, and it will show you all 360 payments and how much goes to pay down the principal, how much is going to the interest, what your taxes and insurance are. The taxes are set by whatever city you live in. The insurance, you get to choose your home ownership insurance provider, so that will vary. And then the mortgage insurance we talked about. So you make one payment, and all those payments, all those 5 categories I talked about, get a little piece of that pie, if you will. The income needs to be stable throughout the process. Depending on what programs we use, and this is more specific to down payment programs, they have their own income limits, so you have to qualify for the mortgage as well as that program. Common down payment assistance programs are MSHDA, which stands for Michigan State Housing Development Authority. They set their credit score, which currently you must have a 640 middle score. Our credit pool is tri-merge, meaning it's coming from all 3 bureaus, and we just take the straight middle score. So if you're looking to use MSHDA with your mortgage product, you must have a 640 middle score. If you don't have that, it doesn't mean you can't get a mortgage, but you will not be able to use that program. The city of Grand Rapids also offers a down payment assistance program, and they have a little different rules than MSHDA may have. These programs set their own income limits to make sure that it's fair for borrowers. So you have to fall under the income limits as set by the program. So in those instances, we're qualifying both for the mortgage and for the down payment program. And if you're telling me I need down payment assistance, we have to make sure that you qualify that before we pre-approve you for the mortgage, because we will need that to close the mortgage. Credit, Tiffany did a great job. So the only things I want to add, DTI, how credit relates. And this can be confusing for borrowers. So DTI in the pre-qualification, that stands for debt to income ratio. So this means that a percentage of your monthly income is allowable for debt that reports to your credit and includes the new mortgage payment, and you must fall under a certain percentage to pre-qualify. A standard number, and again, this can vary, but a standard number is around 45%. That is also MSHDA's maximum for your debt to income ratio. So this means that your new mortgage payment plus any current credit obligations must fall underneath this. 100% of your income is not allowable for your mortgage, because that is not affordable. Car insurance doesn't report to credit. Daycare, which can be a huge expense, doesn't report to credit. Your food budget, which this is what we need to live, we don't know that. So you have to allow for other life expenses, because we don't want you to be what's called house poor, where you can only pay that payment and you can't live. Or in the case of home ownership, you can't afford to make repairs to keep the home in good condition, or you can't afford to do upgrades. So as far as the debt to income ratio goes, know that only a percentage of your income is in 45%. And you can take out your calculator now and if you make 5,000, do times 0.45, and whatever that number is, this is your new mortgage payment plus whatever you're paying now needs to fall under whatever is about 45% of your income. If you're over that number, you may have to get rid of some debt. This could be counterintuitive to what Tiffany told you, because she said, don't close the debt. But if your goal is to buy a home and you are already overextended on the debt, I may say you may need to get rid of some debt. And you have to pick the lesser of the two evils. If you want to get a home, we're not worried about impacting our credit score. We're going to meet this goal of home ownership, and we may have to get rid of some of that debt. Looks like there's a question.
So, for instance, if I got a car 3 years ago when I had bad credit, but they gave me a car, and my car note is $600 a month, you have refinanced some people's car notes or refinanced certain debts that people have to get their DTI under that 45% or at that 45%.
I may suggest that.
Is that some things that you've done before? So sometimes some of the higher bills, like a car note, and people don't think about that when they want to get a house, but they have some debts that are higher. Some of those things can be consolidated or paid off.
Absolutely.
To get to where they need to be for a house.
With the car note, that's a great example because a car is a necessity. And you can get a car with poor credit and have an extremely high interest rate. Some people could pay 25% or more. And if you don't look at that amortization schedule, or sometimes people don't even care, they just want the car. If you don't really know the true cost of that, it, for one, is hurting your pocket. And for two, if I look in the mortgage process and I see a $600 car note and we need to get rid of about $200 debt to qualify for the new mortgage payment, we may suggest that go refinance this car or eliminate some debt. Keep the documentation because I need a paper trail of what's happening here. Yes, it's going to impact your credit, but credit reports are good for 4 months or 100 days in the application. So I'm not going to see whatever impact happens, but I do need to know that that debt has been minimized or eliminated to meet the goal of home ownership. Credit counseling for home ownership is specific. Tiffany, some of your slides said in general, when you get to preparing for home ownership, it's specific to that goal. If you can get approved for a mortgage, you can probably get a car, a credit card, things like that. But if you get approved for a credit card, those requirements are different from the mortgage qualifications. Question, little quiz for you guys. The inquiry for your Macy's credit card at the store and the mortgage, how many people think that's the same kind of inquiry? How many people think that's a different kind of inquiry? Same. A hard inquiry is a hard inquiry. Suspended on the mortgage pre-qualification, because again, if we can get you successful there, you know I can probably go get that as well if your debt to income is in line. But if you're extended, then maybe not. Tiff?
I know we were having a side conversation too, and it's important to know, like when it comes to credit scores, that you know that you have more than 3. I don't know if many people know that you have like over 28 credit scores. You have the FICO 2, 3, 4, 5, you got 8, 9, and 10. 10 just rolled out. So just be aware of that your credit scores may be different. So like Staci said, once they're in their process, not focus on that. So just, take care of the other things that you need to take care of. I've had a client that had to, when she was going through the process, they asked her, could she pay her car off? That could be a possibility. So just know that. Be looking out for those other credit scores as well. So don't, you have to find other sources where you can find those so you can know where you stand as well. Because you may think you have a 680 and then you go and check your FICO 2, it might be a 600. So. Yeah, the 3 ones that they use.
Yes. Do you have a specific credit question that you want me to address? Oh, yes. We do the tri-merge report pulling from Equifax, Experian, and TransUnion. Those scores could be different today than they are tomorrow. But when I pull, you could have just gotten a credit score from someplace else last week, and you come and tell me that score, but I may pull and see 3 different numbers, and then I'm just looking at whatever bureau has give me is the middle number, and then that one sets the tone for the application, determines the rate. Because you can't get an interest rate without having a credit score. That's how the interest rate is determined, by your credit score.
This is a lot of information.
It is.
And I was just self-taught. So all this stuff, I just did. However, I'm thinking, how are young people going to learn this? This really needs to be in all school systems. Even if they don't understand all at first, somebody's going to come back to them when they're getting ready to do this. But without this help, I'm thinking, I'm calling Tanya, or I'm going to direct them to. So it just seems to me that I can't see how a young person will get that point where they think they're ready to get a home and they have to go through all this. You know what? I'm just gonna shrug my shoulders and say give up. You know, and so this is a lot, and I think that we got to do better in our schooling of our young. Even when we get into the 12th grade, they say, well, I'm going into work or I'm going to start the college, but they need to get it soon so they can be ready, because by the time they think they're ready at age 30, 35, they don't have a clue. And this is a lot of information, good information, but an awful lot.
It is. It's overwhelming. And I don't want anyone to believe that it's an easy process, and it is a lot of information. My mother always used to say repetition is learning. So we do need to have these conversations more frequently. I am happy to see legislation that states financial literacy will be taught in high school, because what happens when the children walk out of high school? They're bombarded with credit card offers, and like Tiffany, I messed my credit up first and had to learn through the process of cleaning up. And then as I learned about mortgage, you have a thought of, okay, this is what I need with the credit, and then you learn it's specific to the mortgage process. So without being in this spaces and without people educating people, and repeatedly, you won't know. And then without you going on that journey yourself, because it's specific to you, and that could be different for his journey. So it is important that young people have the education and that they have the discipline to apply it, and then go through the process to learn what does my income, credit, and assets afford me at this time? Is it a 5-year plan? Whatever the case may be, to reach that, so we can break some of these cycles.
And the first thing we talk about building wealth, and they said, well, home ownership is the cornerstone. I think someone made that statement, to building wealth. How are young people going to ever begin to understand how to build wealth? We talk about it a lot, and they say, okay, I can do this. But if this is this can be a vital part to it. This has to happen. This really has to happen. And the sooner we do this, the better. So
absolutely, as a community at large.
That's what I'm speaking
because
about.
Other communities are setting their children up much sooner.
That's what I'm talking about.
Unfortunately, our community, we kind of learn through the mistakes or going through the fire, and we have a responsibility and the opportunity to change that right here, right now.
Exactly. We have to do it. And in some families we do it, but it's going to be more than just our families.
Absolutely.
I think I'm finished for now.
That's okay. I just wanted to mention that Tiffany has an excellent program. I did hear her pitch at the pitch competition, where she is specifically teaching young people credit and wealth management and stuff like that. So I hope I will continue to promote your product and your small business, because it is excellent. And I did vote for you. But also our local Roma, our local NAREP chapter Roma, we are trying to work with school districts and school systems here in West Michigan to get into the classroom, to get in front of some of the young people, because you're right, it currently is not taught to our students and our youth, where it should be and could be. And then they step out of high school, whether they go to trade school or college or just into the workforce, but they'll have some knowledge of credit and wealth building.
And imagine if they step out and say, I'm going to prepare for home ownership, and how that will change their future, the example they will set. There's a lot of things fighting for our young people's attention, and somehow we have to kind of, I believe it's related to the value you have as yourself. In yourself, it will translate to your finances, and it will translate to the behaviors of these wealth building activities. And this is not an instant gratification process. This is a delayed gratification process. And we have to kind of reprogram, and it's a psychological concept. That's another conversation for another day. I'm going to touch on 2 more things for credit, and then I'll move on here. Student loans, hot topic of conversation in the news, and people have, applied for various student loans. I want everyone to know that regardless of what's going on or is being stated by the government, any student loan debt is going to be acknowledged on the credit report. You're either in an income-based repayment program, and there's any amount above 0 that I'm going to say your monthly liability is, or I'm taking 0.5% if you're in forbearance or deferment, and that amount says 0. So just know that zero is never used in a mortgage pre-qualification. There has to be some acknowledgement for the federal debt that student loans are. If you have any questions, write those down and we can address those when I wrap up here. And then assets, we've been talking about that as well. Your options for those, paper trail, paper trail, paper trail. I think I've covered everything there. I do have some information to help with the down payment here. Mercantile Bank offers what's called extra credit program for what's considered LMI, which stands for low to moderate income borrowers, or if you purchase a home in the low to moderate income census tract, we will give $2,500 off your closing costs. This is not a loan. This is a credit to you, so it could cover the gap in those closing costs. Ask me for more information and we can look at your fitting in this program and how this can benefit you. The last thing I want to say in general, in an age of technology and scams, there is such a thing as called predatory lending. If it doesn't feel right, reach out for help. But predatory lending is any lending that imposes unfair or abusive loan terms on a borrower. It is also any practice that convinces a borrower to accept unfair terms through deceptive, coercive, exploitative, or unscrupulous actions for a loan that a borrower doesn't need, doesn't want, or can't afford. A mortgage is your choice. A mortgage is your right. A mortgage is something that needs your agreement to. So if you feel like you are in any predatory situation, please lift that up. It is a right, as it is a responsibility of a loan officer, if that has been lifted up, that we take action as an advocate in the housing industry. So just know that this is your journey and we are all here to support you on